Hey everybody, happy Thursday. Hope everyone had a great day. Let's jump on in. So I got Google here pulled up, and this is a trade that I had closed out today. I do believe, or I could see tomorrow still being another up day for Google. However, it's running kind of right into here where resistance is. Markets are getting maybe a little bit stretched. I don't know if I would use the word stretched, but in terms of a risk to reward, this is NASDAQ kind of right here at my first price target. We're kind of right at it. I could see tomorrow being another great day, or I don't know exactly what tomorrow is going to bring, right? So Google gets to where kind of right around the area where I initially was going to get out of this trade. So I sold those debit spreads. I bought them for $4.20 per spread. Sold them for $7.80. So that's a 87% gain. And again, when I put on these debit spreads, right, the upside's capped. So going into it what the upside you can get is, and with this being a little over 100%, as the maximum upside, and how I was talking about yesterday, I'm never gonna go for the maximum upside. I'll take 70, 80%, 90% or so. And with this particular debit spread, I was only holding on to this for 4 trading days. So 87% in those 4 trading days with the debit spread is pretty killer. So I'm definitely happy with that one. Like I said, I could see this, having another good day tomorrow. Anything's possible, right? But in terms of a risk to reward here, I don't. The 87% was good. You can see this RSI here has now come above 70. I like to use RSI more as a sell signal, as opposed to kind of like an entry signal. So, and plus it's right up here into resistance. In terms of mega tech, I think mega cap in tech, currently I think Google looks the best. Meta also looks fantastic. I think Amazon looks good too. Yeah. So, geez. Yeah, Amazon, actually, I changed my mind. Amazon looks the best. It's at a new all-time high. And this is good. This is indicative of, the economy, the consumer, right? That's good to see in terms of overall health of the economy and stocks going forward. Let's move on to current positions. Oh, another position I took was in NASDAQ. I have a couple different positions on. I'll talk about the positions and why I did it. So with NASDAQ, oftentimes I like to play a leveraged NASDAQ fund, which is TQQQ. QQQ. So I'm in January 1784 dollar calls at $6.70. Those are currently at $7. And then I also have some spreads on there. Those are December 13 expiration, $80 strike price for the long call, and $90 strike price for the short call. Those were $4.40. So again, the upside is going to be more than 100%. And that's what I look for, the debit spreads. Also, so let's go over, why. So NASDAQ was very strong today. My plan initially wasn't to really place any trades going into the FOMC unless the setup looked really good, and so NASDAQ had a nice orderly, very smooth, powerful trend day today. So heading into the FOMC meeting, I thought the price action was beautiful, and I didn't expect anything crazy during this FOMC meeting. I mean, Powell wants to keep his job. Everybody knew he's going to be cutting 25 basis points. I didn't think he would say anything outlandish, and he didn't. Although he did say a couple things like, if Trump asks you to step down, are you going to step down? No. I was like, oh, nice. So, and thinking about it, I didn't think anything crazy was going to happen in this FOMC meeting. I decided to place those trades. And then also, the premiums were a little bit high, I think, given the FOMC meeting. So that's why I decided to place some debit spreads as well, to get some more, credit for those calls that I had sold. And then we can talk about some day trades. I said I wasn't going to place any day trades unless it was a perfect setup going into the FOMC meeting, and it was perfect. Let's get rid of this thing here. Remove drawing. So, I'm on a 5-minute chart here. Where was the morning? Right here. Somewhere in here. Oh wait, oh shoot. Right here. So this morning, I mean, this for me, if I'm going to do any sort of day trading on futures, this is the perfect setup for me. So it turned out that it was in fact a perfect setup. I placed about 3 different trades and NQs that were all good. And I know in my old videos I went over every single day trade that I did and the thought process and everything, and those videos were going really long, so I don't know, maybe I'll do that again, or maybe not, but yeah, I mean, even so, so this was first thing in the morning. I mean, this is exactly everything I'm looking for. And then this was just prior to FOMC. Or was it here? Even just prior to Powell talking, the price action was perfect. So, I mean, I went after it again and turned out to be another really, really good one. So that's enough with that. I had placed those the call options and the debit spreads right in this whole area here. All right, let's move on. The positions that I currently have on, Dow Jones, the same. I didn't sell this, right? I've been holding this one. Dow Jones. Those are December 20th is the expiration, $425 strike price. Those were $7.75. Those are currently $17.75. I think Dow Jones has more room to run, and today was a super muted day in Dow. So here would be kind of my first price target. Depending on what tomorrow holds, I'll continue to hold that position. I might close some out, might not, might close them all out. We'll see. It's still a really good gain, but not quite at what my price target would be. So, moving on over to XLF, I'm in these. This was a much weaker day than I was really expecting. So my first initial price target was right around $49-ish. It blew straight through that. So then, the next target would be $50, 50-ish cents, something like that. Which I wouldn't hold to that level. Much like I trade, debit spreads, I'm not holding it to the max, right? I just kind of, if for example it's $50, 50 cents, I'll get out 49.50, 50, somewhere around there, right? I'm not gonna get greedy with it. But this was a much weaker day than I was expecting. But on kind of heavier volume. Typically I would have got out, but you see, I mean, the volume that had happened yesterday was just completely out of the ordinary. So, given the fact that Dow Jones was super muted, I mean, it was like flat on the day, I was in them, whatever. I've got a great cushion, and those are January 25, $45 strike price, expiring January 25, $45 strike price. Those were $2.88. $2.88. Those are currently $4.45. Which is down pretty significantly from what they were yesterday. The XLF that had a much weaker day than I originally thought. Now let's go over some. Let's see how Goldman Sachs was. Yeah, so down 2%. Berkshire Hathaway is the largest position in XLF. JP Morgan, C minus 4%. Sheesh. MasterCard and Visa, it's down just a little bit. MasterCard, Visa. I think just given the strength of the breakout of all of these stocks, right? I mean, JP Morgan and Goldman Sachs had like 13% days, I don't know if that's the largest gain they've ever had. I have no clue. But regardless, that is massive. So, that was so much money that was buying those stocks. So much, right? Like big institutional money that would move JP Morgan or Goldman Sachs 13%. That's lots of money going into that. So I would anticipate more strength going into the future here. So I think financial services is going to be a really good trade going forward. That reminds me of an interview that I listened to today. Do I want to talk about that now? We'll circle back to it. Let's circle back to this. Bring into financials. So I try not to forget to bring it back into financials. Let's just get through all the current positions that I'm in. TQQ, spread, XLF, Dow Jones. So, obviously I'm still in the 2x Bitcoin fund here. Let's look at the chart of Bitcoin. It's great. It's awesome. Chop around, do all sorts of stuff, whatever, all-time high. That's like a cardinal sin to sell something at an all-time high, especially with a huge basing pattern like this. So I'm going to let those ride. So BITX, I have equity positions in here. $31.80 is the average cost of the shares. And then, like I said yesterday, I have call options in it, but I didn't write down what they were. Tonight I wrote them down. December 20th is the expiration. Their $33 strike price. They were $5.30 when I placed the trade. Those are currently $8.70. And again, those were placed at a really bad time. But when I do call options, I like to buy like 70-ish days out to expiration, 90 days out to expiration in the money, unless I'm doing kind of a different strategy. But just generally speaking, that is what I like to do. And in this case for BITX, this worked out great because the entry point on it I thought was okay. It wasn't great. It turned out to be terrible, although now the price has recovered nicely. But those were down pretty big at one point. But if they were shorter dated options, or out of the money, it would be a massive hill to climb, right? So I'm typically a lot more conservative, just generally speaking, in how I invest or trade, and with options. Just over the years that I've noticed that is what works out best. So it works for me, and I continue to do that. Also, another huge reason is time decay. So time decay kind of starts around 60 days. I mean, there's always time decay, but 60 days, you could say, kind of starts. 30 days is when it really starts getting noticeable, and you get down to 15, it's like significant every day, So general rule of thumb is I like to have a options contract that is twice as long as I originally think that I'm going to hold it, plus another 20 days, right? Because, who knows, right? I have no clue what's going to happen. And I could totally be wrong, right? Wrong often. So I like to give myself as much cushion as possible. Going on over. Okay, so I'm still in NVIDIA. Yeah, I mean, what a good day. I expect another good solid day out of this tomorrow. Typically what I see is after a breakout, you get 3 good days, 3 pretty solid days, right? I mean, you see it here, 1, 2, 3, pretty typical, right? 1, 2, 3, 1, 2, 3, kind of funky, basically 3, right? The other exceptions are down here, but even still, you had, so if we zoom in here, 1, 2, 3, and then kind of down, whatever. So anyways, expect kind of 3 days. I'm not selling this tomorrow anyways, but that's just kind of my thought process. Yeah, and after hours, it's up another $1 or something. Yeah, so. Okay. Goldman Sachs. I'm in Goldman Sachs. Oh, yeah. And then I have one other position I started. Okay, so Goldman Sachs. Yeah, so I've been in Goldman Sachs, $459-ish back here. And I remember getting back into this. Where was this? Yeah, it was like right in here or something. And this is when the Federal Reserve came out with its bank stress test. And it essentially showed banks are worse off than they were a couple years ago. And I remember we did the video, and I remember reading off the article and thinking like, oh, that's nice. They're worse off. But I said, we'll see how the market decides. If the market cares, then I care. If it doesn't, then it, whatever, continued up. So, but I like Goldman Sachs. Goldman Sachs is a strange sort of turnaround play, where they were really underperforming, and shockingly underperforming, and they were doing weird things. And they've kind of, when I decided to get into them, they really turned it around. Revenues were starting to pick back up. I think the feeling that I got from doing research, watching some interviews with the CEO and different executives, they really, I think, were kind of turning a corner. I just got that sense. So they've had a great, history for making money. So I'll be in this one for a while. Okay, Goldman Sachs. Oh yes, the other position I started. So that cannabis ETF. I figured the risk to reward on this is super easy to spot. And the minus 27% in a single day, I believe, was definitely overblown. So I got into this. Price target would be right around $6. So in terms of this, it would be about a 3-to-1 risk to reward for how I would personally trade this. About a 3-to-1 risk to reward. So the risk to reward is good. Cost basis is it's like 512 or something. Yeah, it's it's 512. I don't know where I wrote it down. But anyways, basically like $5.12. Okay. So let's go over some things. Now, hindsight is 2020, and every single trade I do a whole analysis on it, no matter what. And so we'll go over the trades that I closed out. What was it, yesterday? And things that you can learn from it. So silver, and things that I can learn from it. So silver. This one is maybe a little bit confusing. Let's just go to this ETF. So I had entered this trade here, closed it out here below the 50-day moving average, huge gap down. Was that the right call? Well, clearly in hindsight, no. Where this is at right now, I would have closed this out today. Which would have helped. It would have still been a loss, but much less of a loss. So how could I have, learn from that and maybe do something better in the future? Well, my thought process was I had two losers yesterday, and that was the silver and copper. And I was thinking in terms of a Trump trade, I think gold and silver could lag or not do quite as good as they have been doing. My opinion on that can certainly change, and I think the fiscal deficit can certainly change my opinion. But generally speaking, gold is more of a geopolitical hedge, generally speaking. So anyways, my thought process was, wow, these are huge losers. Today is a massive day. Let's cut these losers and get these losers out of here. I don't want to look at them, right? So what is that? Where did that thought process come from? It comes from a place of weakness. That doesn't come from a place of strength. It's more of an emotional thought and more thinking about the money than a good trade. Okay, so that's where I screwed up on that. Hindsight again, clearly I shouldn't have sold it. Now let's go over to copper. I think it'll be easier to look over here, this copper ETF, than the futures chart. Although this does kind of illustrate it a lot better. Yeah, so let's look at this. Huge down day. massive recovery right back. you know. Now, I have no problem getting back into copper. This still looks good. And generally speaking, if you think the economy is going to do well, if you think China's going to do less poorly, then copper can be a good play. You know, copper and gold and other metals are pretty correlated. Now, copper has really diverged itself from gold and silver. So they have a lot of catching up to do to get back to median, right? In financial markets, things always mean revert. Always, they mean revert. I read a quote somewhere that said, like, that's like the greatest knowledge or whatever in financial markets is mean reversion. I don't know if I agree with that or not, but things do mean revert. So the correlation between gold and copper will converge, whether that means gold is going to tank and copper stays the same, or gold goes down and copper goes up. I have no clue. But this still looks good. I have no issue getting back into this. That's for sure. And also where I was going with this, with the economy, just generally speaking, if you have a better economy, then there's more demand for copper. And a lot of it is dependent upon the Chinese economy as well. So there's that. And that thought process for getting out of copper yesterday was the same. And I mean, just the strength of the selling was also a little bit, kind of concerning as well. But anyways, copper looks good. Silver, nah. Copper looks good. Gold, though, like I said, I said, dang, that's right on the 50-day moving average. I had a great recovery off the 50-day moving average. The 21-day and the 8-day EMA, they're starting to roll over. So, right now, I'm not saying that this is a dead trade, but, it's not an obvious entry point. This isn't obvious right now. So I won't be going after this one, but that would be awesome if this gold continues to go up, silver, copper, the more things that are in an uptrend or in any sort of trend, the better. It's more, options to trade. Okay. Let's go over that interview, I guess. So there's an interview with Stanley Druck and any interview with Stanley Druckenmiller or anything he says, I listen to it word by word a million times, and he's one of the greatest traders of all time, and so it was such a good interview, and I'll link that interview in this video for anyone that cares or wants to see it. I think it was done about a month ago or something, but I think it was released yesterday. And in that interview, he talked about amazing things: position sizing, trading psychology, and when him and Soros were shorting the pound famously, he brings the research to Soros, and they're talking about position sizing, and Soros goes, 100% of the fund is not enough. We need to get to 200%, right? And these people, the most successful Soros, Druckenmiller, Bill Ackman, Warren Buffett even says, diversification is for people who don't know what they're doing, but so these people, when they have high conviction, they go after it. And at the time when they were shorting the British pound, I think it was $7 billion were their assets under management, right? So, they wanted to go up to 14 billion, right? So lever up 200%. He said they never got there quite, but it was more than 100% of the fund. It's pretty wild. So, anyways, really interesting things that he talked about. Some of the things he was discussing that we'll talk about here were where he sees things. Now, he was talking about during COVID, there's a lot of mortgage refinancing, some rollover of corporate debt, refinancing there, as well as commercial real estate debt that I have written down. So there's going to be $27 trillion, and this was many months ago that I wrote this down, so it could be completely different, but $27 trillion of commercial real estate debt matures by 2027. 500 billion alone was this year in 2024. That seems to be okay. They seem to have done fine. Anyways, Stanley Druck and Miller, his point was most of this comes due 2025, 2026, coupled with animal spirits, Wall Street and financial animal spirits, due to the anticipation of deregulation and lower rates. So I thought that was super interesting, where why are financial services expected to perform so well? Deregulation. Now he said be cautious about 2025, 2026. He said he could be completely wrong, right? Nobody really knows, but that was really interesting. And where I was going with banks, financial services. And that's it. So then let's go over some winners and losers for the day. Still you have prison stock, Geo, up another 13%, 13.5%. Wow, that's so crazy. Now let's talk about a couple things. Oh, let's see about some losers. Anything that's of noteworthy? Nah, nothing of noteworthy. Okay, so let's talk about a couple things, couple trends that I'll be looking into going forward here. So the first one being biotech. So biotech XBI, this is at long basing pattern. And if this can start moving to an uptrend and these trend lines can start moving upwards, this has plenty of room to go. Now, that's it from a technical standpoint. In terms of more of an investment thesis or fundamental level, biotech performs better when interest rates are low, and money's cheaper. Why? Because there's lots of biotech that isn't really turning a profit and takes on a lot of debt. And there's also a negative correlation with the price of oil, which is kind of strange to me, but it is what it is. I believe there will be downward pressure on oil going forward with a Trump presidency. Why? I mean, because his whole drill baby drill thing, right? So he's going to be drilling here. And then also too with less geopolitical risk, there would be less demand for oil as well. So although the last 2 days oil has been supported, the price of oil has been supported pretty substantially and very surprisingly so, for those reasons that I had just listed. And when you see these candles like this, these wicks down here, you know, this isn't just a few people or 100 or 1,000 people or whatever supporting this price. These are institutional investors in here supporting this price, right? You know, I mean, these are $13,000 per contract. So if you go, let's go like a 5-minute. Oh, this is too confusing. Yeah, so all in here, all this buying, right? So, you know, you got 20,000 contracts traded, you know, 40, whatever, 50. Right, these are $13,000 per single contract, you know? Like, this is institutional money that steps in there and is supporting that price. So, okay, XBI. This is one I'll certainly be watching for all those reasons I talked about. I got off on a little bit of tangent there on oil, but this one I'll certainly be watching. Now, right here is not a good entry point. I would look for something more around $100 or however this pulls back or goes sideways or whatever, an entry point that is better for risk to reward. Right now, the risk to reward is not good. So I would not be going after it right now. Another one, so talking about winners here, and then we'll end the video. I noticed, so Take-Two, you know, gaming company, up really big today, and apparently that's on earnings, and so was that earnings today? No, that can't be. What was this, 11.6 after the market? So okay, so yesterday, and then today, I mean, a massive day. So let's look at some other gaming stocks. So Electronic Arts, look at this. This is up huge. This is a nice cup with handle. Cup, some sort of handle. And it's just gone straight up. I've kind of forgotten about video game stocks since COVID. I haven't traded video game stocks since COVID. So it's been like, 4 years or something? So I kind of forget about these, you know? And then we'll go over to Roblox. I have had this here, this alert at this price for, I don't even know how long. It's got to be forever. This also looks fantastic as well. So video game stocks look great. There's a lot of things. I think the markets are starting to broaden out a lot more, which is fantastic, because although last year was a good year overall for indexes, there was no broad bull market. I mean, I think the equal weighted S&P index was flat or down or something insane. You know, basically it was Nvidia, Microsoft, Google, right, that were doing well. So I believe we're seeing, you know, and then, you know, right, so like Russell 2000 was, you know, completely flat. 2022, 2023 is kind of a little up, a little bit more, whatever, but like completely flat, right? So now we're starting to see things broadening out. Video games, I mean, biotech looks like it could kind of get going here. So, I mean, tech's looking good. Everything looks good. A Caterpillar, Train. Yeah, Caterpillar, Train. So I think there's going to be a lot of good opportunities. Lots of good opportunities. Depending on what happens here with the war in Ukraine, if that's going to stop or not, you know, we'll have to think about how to play that. something else that Stanley Druckenmiller was talking about was when he got into NVIDIA, the way that he invests is if he thinks AI is going to be, for example, AI is going to be a good place to invest, then he looks at the entire supply chain. So everything that would be affected by AI, down to data centers and everything. Utility companies, all that. And that is something that I always tell myself to do, and I just don't. That I need to do a lot more of. I'm much more of a, so he describes himself as a bottom-up macro guy. I'm much more of a top-down, so I'll really kind of stick with indexes like NASDAQ or, but regardless, the more opportunities, the better. Let's see how Broadcom's looking. Ooh, this looks fantastic too. Sheesh. Yeah, see, I mean, there's so many things that are looking great. How's Uber doing with Tesla doing really good right now? Yeah. It's struggling now with Tesla doing good. So that's it. That's all. All right, guys. We'll see you tomorrow for Friday.